Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so stock staging a bit of a rally yesterday as Bostic from the Fed made a comment around that they may be done by kind of late summer. Market like that. So despite yields not really caring and carrying to keep push on because of European inflation data coming in hot, stocks liked it and they had a bit of a rebound. And they were testing those key levels of support. Broke actually below the 200-day moving average, broke below 39.50, but managed to recover in the second half of the day. China also advancing another 2%. Factory output, home sales increasing in February. So generally seeing better hard data out of the Chinese economy and starting to see that reflected in stocks having a bit of a rebound. Commodity-wise, we did see a pause in the bounce that commodities have seen over the last week, basically. And then copper, really the worst hit there, down a couple of percent, having had quite a nice rally. It did meet some resistance that we talked about, this downtrend, this triangle that has been kind of carving out, failed to really break that top of that resistance channel and had a pullback. Volatility-wise, we saw implieds come off as the market, didn't crack lower. So that's, generally met with a bit of relief. So down about a vol point across US indices. Europe and Asian vols held up a bit better. Obviously, Europe is quite a lot cheaper in terms of implied levels. Commodity vol also lower in general. Worst hit really being energy there with oil and nat gas coming down. Copper also pulling back a little bit in volatility terms as well. Carry-wise, positive carry across most of the equities still. So, we do think there's room for this kind of lull in realized vol to persist for about another week until we hit non-payrolls. We have obviously got ISM services today, but given the way that stocks are reacting to higher yields and the fact that they're not cracking lower, I think the bar is quite high to really create a lot of realized on today's number. And therefore, we may get a bit of a quiet period into non-farms. Gold still killing it, 40% positive carry. So the best carry there, but gold does seem to have reversed a little bit. About getting as low as 1805 earlier in the week is now touching that 18, getting close to 1850 again. So a reasonable bounce in gold. We'll see if it manages to actually 1860 is a bit of a level in terms of resistance here. We'll see if this is it. This is it for gold, and it's actually going to change direction. I still think there might be one more push lower, so I'm not rushing to buy too much here. And then finally, copper still in deep negative carry there, chopping around like mad copper. So that gamma working pretty well still. Skew wise, we are seeing skew drift lower. We've been saying skew's been resetting lower all week. That kind of continues as the market didn't break down to the downside, lost that velocity on the way down, and with vols kind of coming in, skew also coming in with it. Dollar wise, dollar did manage to bounce yesterday as yields went higher. But yields are going higher across the board. So we're not seeing massive volatility in the dollar, pushing back up towards 105 in DXY, but not really breaking through it. So staying within the ranges that it's been carving out recently. And like I said, we don't really think FX vol is necessarily the way to go if you're a vol buyer. Moving on, these charts we're looking at. So record high in European core inflation, spook markets. That's why we had our knee-jerk lower. That's why we had US yields exploding through 4%. ECB terminal rates also exploding higher. You see here, terminal rates here, Feb 2024 at 4% basically in Europe. So that's the highest that we've seen. S&P, was looking to break down below that 39.40 area, but vol markets haven't been perturbed this week, right? Fixed strike vol continued to go lower, skew went lower, VIX and VVIX have all been heading lower. That's been telling us that a tactical rally was kind of on the cards. That's what we were talking about. Seems to have started to materialize. CRM, Salesforce earnings were also good. And then Bostic's comments were really the catalyst to get the buying started. And zero DTE call buyers came in back in force, taking the market higher into the second part of the day. Now, the main data point, obviously, ISM services. Like I said, the big move in yields, I don't think we're going to get, even if we get yields higher, the fact that they've been going higher and stocks have managed to rally on that, I don't think we're going to get a massive move on it. Now, if we did get ISM services come the other way and drop, Could that give us impetus for a bit more of a rally? Potentially. This chart from Jim Bianco shows that these swings that we've been having over the last week. So could we push back up towards the top of the range at 40.20 on a low ISM print? Very possible if the rates market does pull back a bit. But then even then, 40.20 I think is going to be a bit formidable resistance in the short term, as at the start of the week where we just couldn't break above that. So for us, we think a range-bound S&P over the next week is probably the most likely outcome. So how would we play that? So looking at the S&P, Nomura vol strategists have also been pointing out that the sharp ratios on systematic vol selling have been a bit spectacular lately, right? So looking at 10-day, 20-day, 50-day sharp ratios across a bunch of indices, EFA is the European ETF, SPY, VXX, and Russell ETFs. These sharp ratios are pretty decent. EFA is really huge, but liquidity is not as great in EFA, and also you need to have an opinion about Europe there. SPY, on the other hand, with all the zero DTE stuff and the mean reversion that's been going on, I'm a bit more comfortable playing SPY. It's in like the 80th percentile in terms of the sharp there. So suggesting that short gamma doing well, no reason to fight it basically, right? So that's what I'm thinking. I'm thinking NFP is going to be your big data point. Looking at the range here, we are sitting in the middle here of the range that we've carved out. We're kind of looking for this 40-50 area to hold on the upside, on the downside, this through 3,900 or 390 on the SPY area to hold on the downside. So we think that range between now and the 9th of March, the day before non-farms next week, is a pretty realistic kind of range for us to kind of stay in. Okay, so that's what, and we've just got back up towards that 4,000 area, which we know is a big strike zone, a very popular psychological level where a lot of strikes are traded around there. So that might become a bit self-fulfilling and hold the market there as well. Okay, that's the trade idea for today. Have a good weekend. I'll catch you all next week. Thanks.